Welcome everyone to another of our weekly manager videos, and many thanks for once again tuning in. Now, fixed income is dominating the market at this moment in time, whether this is how to generate a real return from the broad asset class or how global rising yields are affecting equity returns. It's never been more important to understand the risks and also the rewards in this very broad sector. Today, I have the huge pleasure in discussing the fixed income universe with Andy Seaman, Chief Investment Officer of Stratton Street Capital, specialist fixed income boutique. He's also the manager of the Stratton Street NFA Global Bond Fund, the Next Generation Global Bond Fund, and for what it's worth, in my eyes, a huge innovator in the sector. But first, before we get into the content, if you are enjoying all the videos that we publish, it would be wonderful if you could subscribe to the channel. This really does assist us in delivering our financial planning and investment management content to a wider audience, and you will genuinely be helping us all out on the channel. So, onto the content, and many thanks once again for your time, Andy. First off, who are Stratton Street, and what do you believe makes you different from other fixed income houses?
Well, Stratton Street itself was set up in August 2000. We're a specialist fixed income house. We primarily focus on investment grade bonds. We do have some funds like the Next Generation Global Bond Fund that can have up to 20% in high yield, but predominantly we're focused on the investment grade space. We particularly like high quality quasi-sovereigns that are owned by governments. And the reason for that is that we developed a model many years ago which identifies which countries are wealthy based on something called net foreign assets. So that kind of sets us apart from everyone else, because most people look at the debt of countries. When you follow a bond index, that's what people are focused on. But we instead prefer to look at the assets of a country as well. And that's what net foreign assets does. It's basically the cumulative current account over long periods of time. But the other thing that kind of sets us apart from other firms is our focus on demographics. Recently, I think the world has started to focus a lot more on what's going on with the shrinking of working age populations, for example. But this was something that I'd been studying for many years, and Stratton Street launched a fund called the Next Generation Global Bond Fund in 2016 to take advantage of the fact that a lot of the developed countries in particular were going to see their population shrinking over time. And we felt that we needed a different approach to manage fixed income for the next generation, hence the name of the fund, because what had worked in the past when populations were growing was not going to be the same things that would work in the future when populations start shrinking.
And does that result in a completely different looking portfolio to a standard global bond fund?
Yes, it does. If you think about the components of a standard global bond fund, for example, if you follow the Barclays Global Ag, you'll have a 2.6% weighting to Spain. Spain is one of the most heavily indebted countries in the world, but it also has a population that's going to shrink dramatically over the next few decades. So by 2030, Spain's working age population is going to be 30% smaller than it is today if you exclude migration. And clearly that means debt per head in Spain is going to skyrocket, but you don't get paid on Spanish government bonds. So if you follow an index, you have a weight of 2.6%. But we don't think that makes any sense. So we prefer to lend to those wealthy countries who can afford to pay us back, who may be small or even non-existent in the global bond indices. But we think the risk reward is much, much more favorable to lend to countries and companies who can afford to pay you back, rather than those like Spain that can't.
It sounds scarily like common sense, which you don't tend to automatically think of when you're talking about fixed income markets at this moment in time. But I don't know what how the viewers are taking this on board, because it is absolutely innovative. Looking at today's market, inflation seems to be the dominant conversation topic. What are your thoughts on the subject?
Well, this goes back to the reason we launched our Next Generation Global Bond Fund in the first place, because post the Second World War, we had a baby boom, and that led to excess demand, which then led to excess inflation. So the inflationists of the world are looking backwards and saying, well, this is what happened in the past, therefore we're going to have inflation in the future. But we don't think that actually makes sense, because post the Second World War, when you had the baby boom, you're going to have, or you did have, sorry, excess demand. That led to inflation. It also led to strong growth. But that sort of ended in the late 1960s, early 1970s, because at that point, world population growth started to slow. And now we've reached a situation where by 2050, for example, 48 countries will have smaller populations than they do today. So a massive shrinkage in the total number of people, and worse, the working age populations are going to shrink very dramatically. So if you had excess demand equals inflation post the Second World War, once you get demographic shifting in the opposite direction, you should logically get the opposite effect, where actually inflation starts to fall quite dramatically from the high levels that we've experienced in the past. So the past is not a good guide to the future, as we all know in financial markets.
So how do you think that is going to emerge throughout the world at this moment in time? We've just we've just been commenting that there's concerns within the market, certainly the equity market today, on potential inflation. Do you think people have just kind of got it wrong?
I think they have got it wrong. It's not clear to me why people think that inflation is around the corner. If you look at the Amazon effect, everyone can see that prices have been coming down over time. The high street's been under pressure for many, many years for that same sort of reason. And if you look at what happened in countries like Japan, which went through a shrinkage of its working age population, it's quite clear what happened there. Japan's working age population started shrinking from the mid-1990s. And from that point on, Japanese growth has been zero and inflation has been zero. Yeah. Now the rest of the world is going through the same process. We call it the Japanification of the West. Then the same impacts on growth and inflation is likely to play out here as well. So quite why people think that inflation is going to happen when we haven't had any inflation for 4 decades, of any significance anyway, is a bit beyond me.
Wow, again, a completely different perspective on things. So taking all of that into consideration, how do your portfolios look today?
Well, I mentioned earlier that we don't like to lend to indebted countries like Spain, where the income that we're paid for taking that risk is virtually nil. We also don't think it makes any sense to lend to countries with a negative yield. Some countries may be very creditworthy, but it will guarantee to lose you money. Unfortunately, if you follow a bond index, a larger portion of your index will be made up of bonds that with a negative yield. So it certainly doesn't make any sense to lend to countries on negative yields, whether they are creditworthy or not, in the case of Spain. So we instead look around the world for the wealthiest countries and those with better demographics. So within our portfolios, we'll have Middle Eastern exposures to countries like Qatar. Now, a lot of people will think that the Middle East is just an oil producer, and obviously as a region it is, but Qatar is a major gas exporter. Now, gas is better than oil, and oil is better for the environment in turn compared to coal. So these Middle Eastern countries score much better on ESG than people think. But they're also wealthy, and at the long end you can get yields of around 3% or so, which doesn't sound high by historical standards, but if you look at where interest rates are headed for the foreseeable future, locking in 3% in today's environment, bearing in mind US high yield only yields 3.5%, then that's a very attractive thing to do. So countries like Qatar, Abu Dhabi, Mexico, have exposure there, plus the UK, plus the US. So quite a different mix to the standard Barclays Global Ag weightings that a lot of people would follow.
Yeah, I think viewers will kind of sum up all of this by quite a different approach, from your strategy, from your philosophy, and then the resulting portfolio. And obviously we've spent quite a bit of time discussing this, and I've been trying to get my head around everything that you've been discussing. And it's innovative. It's something completely different. It's something that I certainly don't hear from anyone else. And the performance has come through. There's no doubt about it. So I will be hugely intrigued in finding out how the process goes on and the fund's performance. But yeah, food for thought, I think, is the understatement of the day. But Andy, thank you very much for your time. I really do appreciate your time today. You stay safe, and I'm sure we'll catch up soon.
Great, nice to speak to you.